Hi, I'm Warren Buffett. Do you feel overwhelmed the moment you hear the word investing? Does your brain shut down the second you see a financial statement, especially the income statement? Well, it's really not that complicated. To me, the income statement is just a report card. It clearly tells me how much a company made, how much it spent, and how well it's been managed over the year. Today, I'm going to personally teach you how to read this report and how to identify truly competitive businesses that are worth holding for the long term. Investing isn't gambling, it's based on knowledge. So, let's make smarter decisions together. Over the decades of my investing career, the income statement has been the financial statement I turn to the most and trust the most. It's called the income statement, or sometimes profit and loss statement. Simply put, it's the report card of a company. It records all of the company's revenue, expenses, and final profits over a given period. Just like you check your bank account at the end of the month to see your paycheck, spending, and savings, the income statement lets me instantly judge whether a company has sustainable profit potential. Don't worry, I'll walk you through it in the simplest way possible. 1. Gross margin. When I look at a company, I usually start with gross margin. Why? Because gross margin directly reflects whether a company has pricing power. In other words, do people willingly pay more for its products? Gross margin is simple. Revenue cost of goods sold, divided by revenue equals gross margin percentage. If a company sells a product for $100 and it costs $60 to make, the gross profit is $40, and the gross margin is 40%. You might ask, Warren, what's considered a good gross margin? Well, if a company can maintain a gross margin above 40% over time, it often means it has a durable competitive advantage, or what I call a moat. Take Apple for example, one of the companies I've invested in. Their product design is outstanding, the brand is powerful, and their ecosystem is tightly integrated. Even though customers know it's not cheap, they still buy. As a result, Apple's gross margin has remained above 40% for years. That means they can sell products at strong prices because customers trust and love them. They're not just chasing the lowest price. What about a gross margin between 20% and 40%? That usually means the company is in a highly competitive industry. Products are less differentiated, and companies must rely on cost control or marketing strategies to maintain profitability. These companies can still do well, but I analyze them more carefully to assess sustainability. If gross margin falls below 20%, you need to be very cautious. This typically signals a heavily saturated market, price wars, and customers who only care about getting the cheapest product. Take airlines like Southwest or Ryanair. They offer basic transportation, and customers mainly look at the ticket price. That forces airlines into constant price cutting, squeezing their margins, often below 20%. Can they make money? Maybe. But they rely on high passenger volume and extreme cost control, not pricing power. To me, that's not an ideal business. It has no real moat. So, I don't just look at the number, I think about the industry structure and whether the company has an edge. To me, a high gross margin is the first sign of a moat. If it's consistent, that company deserves a closer look. 2. Selling, general and administrative expenses, SG&A. Next, I look at how much a company spends to operate. That's where SG&A comes in. SG&A stands for selling, general, and administrative expenses. It's usually listed separately on the income statement and includes the company's day-to-day operating costs, things like advertising, office rent, administrative staff, and sales team salaries. Why do I pay close attention to this number? Because it tells me whether a company is making money through genuine strength, or just burning cash to maintain its market position. Let's say a company has a high gross margin. Sounds good, right? But if it turns around and spends nearly all of that margin on advertising, promotions, and maintaining a massive sales force, then it's like earning $1, spending 90 cents, not much profit is left over. I like companies that can control their SG&A. If a company can keep SG&A under 30% of its gross profit, I get very interested. Why? Because that usually means the brand is strong, and the product is attractive enough that customers come on their own, without needing huge ad budgets. That's typically a sign of what I call a moat. Apple is once again a great example. Many people think they spend a fortune on advertising, and it's true, they run global campaigns, open flagship stores, and produce high-end marketing content. But did you know? Apple's products are profitable enough, and its brand and customer loyalty are so strong, that even though their SG&A might seem large, it consistently stays below 30% of their gross profit. They don't need to burn money like a startup to get noticed, they rely on trust and user experience. What if SG&A falls in the 30% to 80% range? That's still acceptable. These companies likely have solid products but need some level of marketing to maintain operations. Coca-Cola fits here. They advertise globally year-round, but their product is low-cost, sells in massive volumes, and has high margins, so their expenses are well spread and manageable. However, if SG&A exceeds 100% of gross profit, I become very cautious. Why? Because it means the company isn't making enough gross profit to even cover its operating and marketing expenses, let alone R&D, interest, taxes, or anything else. In other words, the business is barely staying afloat. Uber is a textbook example. In its early days, the company pursued aggressive global expansion with a cash-burning strategy. They heavily subsidized drivers and riders, spent big on advertising, and fought for market share. But their gross profit couldn't support those costs. At one point, their SG&A was over 150% of gross profit. That meant the company was running on investor money, not actual operating income. I understand that some startups operate this way in the early stages, but I won't invest in companies like that. Because if they can't keep the funding flowing, they won't survive. So for me, SG&A is a critical signal. I don't just look at how much is being spent, I ask. Is this company attracting customers because of its brand and product? Or is it desperately throwing money into ads just to keep sales alive? In the long run, I only want to invest in companies that can earn steadily while spending wisely. Those are the businesses I'd be happy to hold for 10, 20 years or more. 3. Research and development, R&D. Next, I take a close look at a company's operating expenses. A lot of people think that to find a great company, you need to chase tech startups, because they're innovative, futuristic, and cutting edge. But let me be honest, in my decades of investing, I've rarely touched companies that require heavy spending on R&D. Why? Because to me, the key to investing is seeing the future clearly, not betting on technological breakthroughs. If a company's competitive edge depends entirely on innovation, I ask myself, what happens if the technology becomes obsolete? What if the R&D fails? What happens to the hard-earned money I invested? That's why I pay close attention to R&D expenses. To me, it's a warning signal, not because spending on R&D is inherently bad, but because I ask, does this company have to spend heavily on R&D just to stay relevant in the market? If the answer is yes, I proceed with caution. Take semiconductor or AI software companies, for example. Their R&D spending can be 30%, 40%, or even more of their operating profit. They have to invest big every year just to stay ahead, and if competitors leapfrog them or they take a wrong turn, that money is gone. Sure, these companies might look like fast growers on the surface, but their edge is often short-lived and unstable. And I'm not a fan of businesses that need to win the race by running faster. Because in a race, someone always catches up. Instead, I prefer companies that barely need R&D, yet still earn steady profits year after year. Think about Coca-Cola. What kind of R&D does it really need? Almost none. Its formula has barely changed in over 100 years. But thanks to its brand, flavor, and emotional connection with consumers, it sells incredibly well around the world. That's what I call a stable business model. Another great example is Moody's. They provide credit rating services, built on expertise, historical data, and trust. They barely need to develop new products, yet they generate high margins and strong cash flow year after year. To me, that's an excellent investment. Now, I'm not saying all high R&D companies are bad. What I'm saying is, I prefer companies that don't rely on constant innovation to earn steady profits. These kinds of companies aren't gambling every year on the success or failure of R&D, and they're less likely to be knocked out by a new competitor overnight. More importantly, low R&D spending usually means a stable business model, predictable demand, and a sustainable competitive advantage. These three are exactly what I look for in a strong economic moat. So if you come across a company that barely needs R&D but consistently generates high cash flow and stable profits, that's probably a company I'd quietly study, and then invest in heavily. 4. Interest expense. There's one line on the income statement that I always pay close attention to: interest expense. To me, it's a type of expense I don't like to see. Why? Because interest expense means the company has debt, it needs to borrow money to operate, expand, or just keep its cash flow afloat. And I've always believed a good company shouldn't need to borrow money just to stay alive. Here's how I look at it. If a company has strong cash flow and steady profits, it should be able to fund its own growth using the money it earns. But if a company is constantly borrowing, especially if it borrows large amounts, and spends a big chunk of profits just on interest payments, I get very cautious. I usually calculate a simple ratio. Interest expense as a percentage of operating profit. That helps me quickly judge whether the company's finances are healthy. If the ratio is low, say, under 10% or 15%, that's great. It means the company earns enough that interest payments are no problem. These companies usually have a moat, a sound financial structure, and are worth holding for the long term. But if interest eats up 30%, 40%, or even more than half of operating profit, well, that's a big red flag. Remember, interest is a mandatory expense. You can delay investments or skip a dividend, but you can't skip interest payments. That means the company has to pay creditors every year before it can even talk about growth or returns. I'm especially wary of companies in capital-intensive industries that constantly rely on borrowing just to keep running, like airlines or heavy industry. These businesses require huge capital outlays to buy equipment, upgrade machinery, and expand operations. And how do they fund that? Through debt. And the more debt they carry, the higher the interest burden. Let me give you an example. Imagine an airline that earned $1 billion in operating profit this year, but spent $600 million just on interest. That leaves only $400 million for everything else: operations, dividends, taxes. If the economy slows down, oil prices spike, or travel demand drops, these highly leveraged companies are often the first to fall. Now, I'm not saying all companies with debt are off limits. You have to compare within the same industry. Take banking, for instance. Every bank has debt, because that's how the model works. They take in deposits and lend them out. Even so, I still choose to invest in banks with the lowest interest expense ratios and lowest cost of capital. Picture a bank whose interest expense is well below its net interest margin and still grows steadily. That tells me it has an effective business model, a solid management team, and strong risk control. Even in a high-leverage industry, that kind of company earns my trust. That's why I always tell young investors, interest expense is like a financial health check for a company's debt. It may look like a small line on the income statement, but it tells you whether the business is running on earned money or borrowed money. As for me, I prefer companies that rely on their own earnings, have strong profits, and can survive without needing to borrow heavily. 5. Net profit. A lot of people think that the higher a company's revenue, the better the company. But I've never looked at it that way. What I care about is how much money the company actually keeps at the end of the day. Net profit, simply put, is the amount a company truly earns after subtracting all costs, operating expenses, taxes, and interest. It's like a ball game. It's not about how many times you swing the bat, it's about how many runs you actually score. So, how do I judge whether a company's net profit performance is good or not? I usually look at two things. First, net profit margin. This is one of my golden indicators for evaluating a company's competitive advantage. What is net profit margin? It's net profit as a percentage of total revenue. The higher this ratio, the more efficiently the company turns revenue into real earnings. To me, if a company can consistently maintain a net profit margin above 20%, that's a very strong signal. It means the business has some form of advantage that's hard to copy, whether it's brand strength, network effects, intellectual property, or a unique operating model. Take Apple for example. Its products have high margins, loyal customers, and a robust ecosystem. That's why their net profit margin stays above 20% year after year, sometimes even over 25%. To me, this isn't just a nice number, it's proof of a moat. On the flip side, if a company's net margin is below 10%, I pay special attention. That usually means the industry is highly competitive, products are easily replaced, and there's little differentiation. Industries like manufacturing or retail often fall into this category. Their profit margins are razor thin, and even a small rise in cost can push them into the red. Second, long-term, stable growth in net profit. I don't just look at a single year. I zoom out and see whether a company's net profit has been growing steadily year after year. One great year doesn't impress me, it might just be a one-time gain from selling assets or a result of accounting adjustments. What I really ask is, does this company have the ability to earn steadily, year after year? Coca-Cola and Moody's are perfect examples. No matter what the economy is doing, there's always demand for their products and services. They deliver solid net profits almost every single year. They don't rely on hype or high-risk plays, they build trust over time and manage their businesses with consistency. That's the kind of company I consider ideal. I know some people chase explosive revenue growth or short-term profit spikes. But I prefer companies that let me sleep well at night, businesses I can hold for 10 years without worrying. After all, I'm not buying lottery tickets, I'm buying a machine that generates cash automatically, and that machine needs to run reliably for a long time. 6. Earnings per share, EPS. Now, let's talk about a metric that many investors pay close attention to, earnings per share, or EPS. What is EPS? Put simply, it's how much profit a company earns per share of stock. At first glance, this number may seem straightforward. But behind it, there are quite a few important details you should pay attention to. First, I look at the long-term trend of stable growth. I don't get excited just because a company has a high EPS in a single year. Instead, I look at a longer time horizon, 5 years, 10 years, or even more, to see if EPS has been steadily rising. A company with real competitive strength doesn't need flashy spikes in earnings or media hype. Its EPS will simply climb steadily year after year. And what does that tell me? It means profits are growing. It means the business is becoming more efficient. And it means the company is consistently creating value. Companies I've invested in, like Coca-Cola, Moody's, and Apple, fit this profile. Their EPS rises like a staircase, step by step, with no sudden drops or wild swings. That kind of consistency is one of the things I value most. Second, I'm very cautious about dressed-up EPS. Some companies make it look like their EPS increases every year. But if you look closer at their net profit, it's actually going down. So why is EPS rising? There's usually only one reason: they're buying back shares. Now, let me be clear, share buybacks aren't bad. In fact, I believe they can be very good for shareholders in the right situations. What I dislike is when buybacks are used to mask the truth. For example, a company earns less this year than last year, but it reduces the number of shares on the market. As a result, EPS looks higher, even though profits actually fell. That's not operational excellence. That's financial window dressing. Do you see the problem? EPS going up doesn't always mean the company is truly earning more. It's like a student doing worse on an exam, but secretly erasing wrong answers to make the grade look better. It may look nice on the surface, but there's no real substance underneath. I don't invest in companies like that. Third, I prefer EPS growth driven by real profits. If a company has strong operations and steady cash flow, and it then uses surplus earnings to buy back shares, that is meaningful EPS growth. That's a business using its own money to reward shareholders and truly increase the value of each share. That's why I always look at EPS trends together with net profit trends. These two should rise together, in the same direction. If EPS is going up but net profit is going down, I stop immediately and reevaluate the business. Alright, that's all for today. Now you've seen how I look at an income statement, and you've learned the 6 key metrics I rely on most when evaluating a company for investment. Let's quickly recap. Gross margin helps me determine whether the company has pricing power. A company with a sustainable competitive advantage usually maintains a gross margin above 40% over time. SG&A, selling, general and administrative expenses, shows me whether the company is burning cash just to maintain its revenue. If SG&A is close to or exceeds 100% of gross profit, be very cautious. Without constant funding, these companies simply can't survive long-term. R&D, research and development expenses, tells me whether the company is overly dependent on the tech race. If R&D takes up more than 30% of operating profit, it usually means the business has a fragile and short-lived edge. Interest expense reveals whether the company grows with its own profits or relies on borrowed money. Generally, if interest expense is under 15% of operating profit, that's a sign of a healthy financial structure. But keep in mind, this ratio varies widely by industry, so you need to compare within the same sector and look for the company with the lowest interest burden. Net profit. This tells me what the company truly earned at the end of the day. If a company maintains a net profit margin above 20%, that's usually evidence of a moat. If the margin is below 10%, I take extra caution. It often means the business faces fierce competition, low differentiation, and high substitution risk. EPS, earnings per share, helps me see whether a company's growth is real or just financial window dressing. A truly competitive company will show steadily growing EPS year after year, accompanied by rising net profits. When all 6 of these metrics check out, that's when I know I may have found a company worth digging deeper into, or even holding for the long term. I often say, investing isn't about predicting market emotions, it's about understanding the true nature of the business. Financial statements are the language of a company. The better you learn to read them, the easier it becomes to spot truly valuable investments. If you found this step-by-step approach to analyzing financial reports helpful, don't forget to subscribe to this channel so you won't miss what's coming next. In the next episode, I'll take you through my second favorite financial statement, the balance sheet. I'll show you what a solid asset structure looks like and how to spot the financial landmines I always avoid. Trust me, you won't want to miss it. I'm Warren Buffett. Thanks for watching, and I'll see you next time.